right, welcome to the Art of Boring podcast. This is the Q3 quarterly update. Our regular contributor, Greg Peterson's here with me today, and he's our asset mix chair. Greg, thanks for being here again.
Hi, David, and hello, everybody that's listening.
And viewing this time. This is our first recording, so we're both excited about that. And let's jump right in. There's a lot to talk about this quarter. Markets have been more volatile than normal recently. What are markets reacting to create this sell-off, but also the big swings we're seeing day to day?
Yeah, there's been massive swings in the markets over the course of the year, and I don't think we need to tell our listeners that at all, because everybody's more than likely noticed that over the course of the year. And volatility continued through the summertime. What was interesting this summer was, markets are always forward-looking, anticipatory, and probably got ahead of themselves somewhat, but in a nice way for the rest of us. So, we had the month of July where equity markets were positive. That spilled into August. I think it made us all feel a little better. At least we had some movement in the right direction, or the right direction of volatility. Gave us a little bit of reprieve from some of the negativity that we've had this year. And then, of course, by the time we got to the end of the third quarter, that had slipped back away again. So we actually ended the quarter with just a very, very slight decline. But massive swings. So if you didn't pay attention to what happened through the 3 months, and you just looked at the end result, you're like, okay, well, we just slipped a very little bit, but there's a lot of movement that took place during the quarter. And really what's leading to that is just not to ignore your question entirely, David. We're going through a secular transition from lower interest rates and a period of low inflation for a very long time. And as you go through these inflection points or transitions, there tends to be a great deal of volatility because of the amount of uncertainty that's out there. So the range of outcomes that exist at the moment, if you're somebody who's trying to forecast, which is obviously very difficult to do, but a very wide range of probabilities, and you have markets reacting to that fairly quickly, based on little nuggets of information that come out from time to time. And much of that had to do with inflation at the moment and the transition to higher interest rates. But every time we go through a period like this, unfortunately, it's not that often, it is very volatile, just as the markets try to grasp where are we going from here.
Yeah, so it's been a tough year for investors. Is this normal or is it different this time?
It's both normal and different. Markets going through transition and cycles is very normal. Markets going through corrections of this nature, also very normal. And what's different, or I think what's most different this time, is that this has been the worst bond market period since World War II. So we haven't seen this very often. And particularly for balanced or more conservative investors, normally when equities are going through a rough period like this and declining, you at least get some protection from bonds, or even some offset if bonds are going up at the time stocks are falling. This time we have both bond and stock markets dropping at the same time, and in reaction to the same variables. So it's inflation and higher interest rates that's causing both markets to decline. And I would say that's what's different this time, is we don't have that same offset from fixed income.
So has that changed our investment approach at all, those dynamics that you mentioned?
It hasn't changed our investment approach. So we still focus on the same or similar long-term fundamentals that we always do. We do maintain a very broad and diversified portfolio. In the course of the year, we have kept our bond weight somewhat lower in the balanced fund. That's not highly unusual for us. We do tend to have bonds relatively low, but we have had bonds low this year. And we've been reducing our equity weights through the course of the year also, just to be somewhat more conservative.
So same approach, but a few adjustments made at the asset mix level.
Adjustments at the asset mix level, also adjustments at the security level. So adjustments are always taking place in the portfolio based on both long-term views and then what we might see coming in the next little while. On the security level, adjustments have been taking place for quite some time, where starting to shift from higher value stocks and businesses that have maybe valuations have become a bit more stretched, or companies that we deem to be longer duration. So what I mean by that, and duration is quite often a term used in the bond market, but long duration companies are really growth stocks where you're paying more for future growth than what you're paying for the current environment. And those stocks tend to be more sensitive to changes in interest rates or discount rates. So our team has been gradually moving capital away from sort of longer duration stocks and tech companies are often a good example of long duration. You're paying for future growth in many cases, to businesses that have very strong cash flows that are the valuation is based on today's cash flows and not so much the future. So that transition has been taking place within the portfolio. And then from an asset mix perspective, it's just to stay fairly neutral, become more conservative, sort of batten down the hatches, as it were, and try not to second guess or try to guess what's going to take place tomorrow. So I think one of the worst things we can try to do is to predict what's going to happen, and then adjust portfolios in the short term based on that. So you're starting to chase some of the short term narrative that's out there at the moment. And the problem with short term narratives is that things often turn out in a different manner than you expect. So just as a very stark example today, so we happen to be recording this podcast on the day that US CPI came out. Inflation was a little bit hotter than the market expected. Day started with markets down about 2% this morning, and now they're up, and we're still a few hours away from close, so we'll see where we go. But the reaction to hotter inflation you would naturally expect markets to go down. It means that the Federal Reserve is likely to continue to raise interest rates even further, negative for stocks, and yet the market's moving the opposite direction. And that's something that can often happen.
Yeah, it just seems a case of the market trying to digest information. And a big piece of that is, as you pointed out, and everyone's probably aware, is the inflation piece, which is ultimately leading to the interest rate piece. How difficult is it to predict where inflation's going? Are there any leading indicators we can look to provide insight there, or is it still too noisy?
Yeah, it's always very noisy. So inflation is a tough one to grasp. Central banks have a very difficult time predicting where inflation is going. There are some indicators you can watch. So things that you can keep an eye on, particularly with the labor market. So wage inflation often translates into goods and services inflation. So that's one area to keep an eye on, just for some signs of where things might be going. Commodities, you can, input costs and so forth. So we've seen some better signs on food inflation that's softened somewhat. There's some early indicators, used cars in this particular example today. Inflation there has been slipping back a little bit. Shipping costs, there's a few things you can watch early on that will take some time to gradually show up into the CPI numbers. But those, I would say the labor market is probably the key to having some sense of where inflation is likely to go. And then the other thing that central banks keep an eye on is inflation expectations. So there's a number of ways to gather inflation expectations. It can be implied in the markets. It comes from surveys of consumers and so forth. And why that's important is if inflation expectations start to move higher, it becomes more difficult for central banks to rein in inflation in the next little while. And why that's and what happens there is if you as a consumer start to expect that, well, prices are going to continue to rise 4, 5, 6%, that gets baked in, you get used to that. It's very easy then for prices to just move up 4, 5, or 6% and continue to move at that pace. So it's one of the gauges that are watched quite closely is expectations.
And how are consumers faring in the face of higher interest rates, which a lot of people, the main issue there is, repaying mortgages at higher rates and a higher inflationary environment. Are consumers holding up all right?
Yeah, so far consumers are holding up really well. I'd maybe mention a couple things. So we're coming out of the pandemic, which was a very major disruption to the global economy. And when you have a disruption of that size, you have some fairly large waves that come out of that. And so, the first wave, as we go through the global shutdown, was then a big surge in goods purchases. So, people are stuck at home. We have nothing else to do. Let's buy some stuff and have it shipped in by Amazon or somebody. So you had a huge surge in goods. That kind of subsided. People ran out of things to buy. Now we're transitioning to services. So, the businesses are opening back up. People are going in person to dine out, travel, and so forth. So now we've kind of shifted from goods to services. And so that tends to be fairly bumpy as we move along. And overall, consumers are still in pretty good shape. So labor markets are strong. People are employed. We have pretty solid wage growth. And it depends on what country you're looking at. Consumers are also in pretty good shape financially from a household net worth perspective. So, consumer balance sheets in the United States are in very good shape. Debt was reduced coming out of the financial crisis in 2009. Whereas other countries like Canada is perhaps not in as good a shape, where consumers here are carrying higher debt levels, higher debt servicing costs. And so in higher interest rates and higher inflation are likely to put a bigger dent in Canadian consumers as we go forward. And one point to just make on that too is in Canada, we have a higher percentage of variable rate mortgages in this country. So higher interest rates translate into higher monthly expenses very quickly, given the variable rates. Whereas if you look at a country like the United States, they have a much higher percentage of mortgages that are in fixed rates. So consumers there are locked in and not as exposed to rapid changes in interest rates from that perspective. So I would expect to see consumer spending starting to slow. We haven't seen it a lot. It's just started to soften. But not that we're trying to predict, but that would be the natural path of things, just to start to see consumers slow down in the face of higher prices and higher monthly costs.
As you say, the mortgage side of things is a big part of consumer expenditure, and with rates going up, that means mortgage rates have gone up. How does the Canadian real estate market look at the moment?
I've been hearing for well over a decade how expensive the Canadian housing market is. And every time I go away to investment conferences, the rest of the world kind of harps on the Canadian housing market. We have seen activity slow significantly in the Canadian housing market. We've started to see prices soften somewhat, so we haven't had a rapid change, but prices have certainly softened. And I think it's reasonable to expect that Canadian housing will continue to soften from here in the face of much higher mortgage rates and interest rates than what we've seen for some time. Very hesitant to predict, just given that it's been predicted for well over a decade, and some much smarter people than me are saying the Canadian housing market needs to adjust lower. But it would seem reasonable that we're probably at that point. And so that would be my best guess, is that Canadian housing prices probably soften and decline somewhat from here. Either way, for us, that's just a headwind for Canadian consumers. So we've talked in the past on this about our concerns around Canada because of household debt levels. And then now, sort of perhaps deteriorating household balance sheets doesn't really create a great spending mood for Canadian consumers, and likely create some challenges here. This also points to the challenges for the Bank of Canada. So the Bank of Canada has been fairly aggressive in raising interest rates to deal with inflation here, and they'll have a fairly fine tightrope to walk to not push the Canadian housing market too far.
On another thing that's close to home here in Canada is energy. Have we reassessed our view of energy? It's had strong performance this year. Do we look at it any different at the moment?
Yeah, energy is probably one of the bright spots for the Canadian economy. So, stronger energy prices, oil and gas companies and services companies are in a better position here, and so that is likely to and has contributed to the Canadian economy. In 2022, you can see it through tax revenues, both at the federal and provincial level also, where it's been a strong contribution. Within our portfolios, we've added marginally to energy, haven't made a significant change necessarily. And for many of the reasons we've talked about in the past. So while yes, it does seem like a brighter prospect at the moment and companies are performing well, as you balance that against sort of longer term trends, that may keep a cap on energy prices as well. And so energy businesses are price takers. They can't set their own price. It's set by global markets. There's only so much that they can contribute in terms of competitive advantages. And so we've added somewhat because it seems that they're in a good position at the moment, but not a wholesale change.
Yeah, and I think some of that attractiveness has come on the back of companies being more proactive in paying down debt and repurchasing shares and whatnot. So it's more that side of things that's been more appealing as opposed to the higher energy prices outright. Is that fair?
Yeah, energy companies have been much more disciplined with capital expenditures, and they've done a great job of managing their businesses. And so we've become more comfortable with their capital allocation and their long-term business model. So that has helped to build the case for us.
And we always have a lot of clients asking about energy, but we also have a lot of clients who ask about foreign exchange. And we're seeing the loonie depreciate against a pretty strong US dollar. What's influencing the exchange rate right now?
Yeah, there's a few things. One of the most central influences on foreign exchange is monetary policy. So, as much as the Canadian or the Bank of Canada has been raising interest rates, the Fed has been raising as much, and I think expectations are probably that the Fed needs to raise further. And I'd also say that to me, the currency is almost like your stock price for a country. So it also, there's some evaluation on the economic situation for the Canadian economy that probably weighs slightly on the Canadian dollar versus the US dollar. So the two combined, monetary policy, and then economic prospects are likely a bit brighter in the US. And for some of the reasons we talked about, US consumers are in better shape. Employment markets are running fairly strong down there. That helps to contribute. And then also in times of transition or sort of higher risk environments like this, capital does tend to flood to the US dollar. So the US dollar has been up against the Canadian dollar this year. I think it was up about 6.5% in the third quarter, which actually helped, by the way. So your US portfolio now is helped by that 6.5% appreciation of the US dollar in the third quarter. But the US dollar is up against all major currencies, in part because of that capital flight to the US dollar. One thing I would just mention too is that the Canadian dollar has actually held its own. So we always look at it, or many of us look at it relative to the US dollar all the time. But the Canadian dollar is actually up significantly against the euro this year, the British pound, and the Japanese yen. So this has had the opposite effect on some of the international portfolio, in that as those currencies are dropping against the Canadian dollar, the value is actually declining in addition to the stock decline. So it actually exacerbates the decline in international assets for the time being. Whereas the opposite on the US side, growth in the US dollar helps to offset some of the declines of the US market.
With the US being such a strong currency, does that, putting your asset mix hat on, does that change your assessment of how you look at the US and how much we decide to allocate there?
It does help us a little bit with the US. So, because we're in times of pretty high uncertainty at the moment, having the US dollar in our back pocket, as it were, as part of that allocation to US equities, is very helpful as a risk mitigator. So we do look at that from that perspective. So being the reserve currency of the world, much more comfortable holding US dollar assets, in addition to the fact that the US economy is likely somewhat more resilient also. So there's many things that we have to try and balance on asset mix. One is, if you look at valuations, US market probably still looks a bit more expensive compared to other markets in the world, despite having come down significantly this year. But that valuation can also be justified given the strength of the businesses there, the resilience of their economy, and so forth as well. So you're paying up a little bit more for what's likely a more consistent and somewhat safer market.
And those relative valuations don't always revert, do they? The US has been, quote unquote, overvalued for quite some time. It can sustain for longer than anticipated.
It can. The US market's been one of the top performing markets for a very long time, well over a decade. Usually there's some change to that. The US dollar is an impediment for global companies based in the US as they translate foreign revenues back into the US. That's a bit of a headwind for them. So we'll likely see that contribute to earnings and margins compression for US companies going forward. But you're right, that can last for a very long time.
Yeah, never an easy decision. And another tough one is there's been a bit of a change in the landscape, really, with cash and bonds. Now that rates have gone up, you're actually getting some yield there for investors. So how does that change the dynamic when you assess cash and bonds and the yield that you're getting versus equities?
Yeah, you actually get paid to hold cash and earn a decent yield in bonds nowadays. So holding cash, we do have a much higher cash weight in the balance funds than we've had for some time. And it makes it less painful to hold cash. You don't feel like you have as big an opportunity cost because you're actually getting paid pretty decent rates on T-bills these days and other cash products. I think this is important too, because this is a change. We haven't had positive yields on cash and bonds. Well, we've had positive, but not very good yields for a long time. And so I think for pensioners, pension funds, people who are living off of a fixed income, it's been a very difficult period. And I think the fact that we actually have some decent yields coming back on the bond market is likely to be more helpful for that. So we've definitely seen the decline in the prices this year, and so the capital decline. But there is a bit of an offset, and now this is setting up a better environment going forward to actually earn more income. So the income component is readjusting and becoming more positive going forward. For many years, there was no alternative, and you often heard that expression that there is no alternative, and equities were the only place you could find any sort of returns. There are alternatives now, so it does provide some more optionality.
So we've talked a lot about sort of the negatives out there. It's very easy to see those, but what positives are we seeing in the economy right now?
Yeah, I think the positives are, as I mentioned, the strength of consumers and labor markets. So we're into this period with low unemployment rates and so forth. So we're in pretty good position from that perspective. Depending on the country, consumers are in good shape. Businesses are, at least the businesses that we invest in, are in also very good positions and have strong competitive advantages. And one other thing that I think we probably talked about, mentioned last time too, is we spend a lot of time looking at the at financial markets and the financial environment in general, and the financial system is also in pretty good shape. So that I mentioned that because the financial system is really the backbone of the global economy. If that's not in good shape, it's very difficult for everything else. And that is still fairly sound. We've seen a couple of hiccups. The UK policy missteps have not been helpful. However, overall, banks are very well capitalized, and that's quite different than what we saw back in 2008, which was really the last time that we went through a sustained downturn of this nature.
Is there any concern there with what's going on in Europe, either the UK, what's happening in the bond market, or as we head into winter, there's concerns around energy insecurity as the Russian and Ukrainian conflict continues? Any concerns there, and what's our exposure to that part of the world?
Yeah, we always have concerns, David. And certainly there's no shortage of things taking place in the world right now from a geopolitical perspective to really harm sentiment somewhat and make it more concerning. Europe has been pressured from Russia on the energy side of things, and that's been very well communicated, and people are probably very well aware of that. One thing I would maybe point out is that Europe has done a very good job of replenishing energy supplies going into the winter, and also readjusting where their access to energy is coming from. For instance, setting up floating LNG ports to try and improve and access to LNG shipments from other part of the world and so forth. So they've done a pretty good job of reassessing energy supplies and making sure that they're in a good position for that. Naturally, the unknown will be how cold this winter is. If you have a very harsh winter, it's going to draw down those energy supplies. But by and large, they're in good shape at the moment. As far as the UK market goes, yeah, they have some things to work through with their pension funds and bond market. I suspect that the Bank of England will be ready to step in and help out as they need to. It's also a pretty fine balance for them too. The UK can't just write a blank check and say we're going to cover off everything and go back to our bond purchasing in face of much higher inflation. So they have a very careful message to try and broadcast to say we're tightening very carefully to try and deal with very high inflation, but we're not going to let the system fall apart at the same time either. So the UK has some self-imposed policy missteps that we would hope don't broaden out into the broader system.
Another piece of all of this is that moves markets is corporate earnings. So we've just finished the third quarter. Companies are, we're coming into earnings season. What are we expecting there, and how is that going to shake out with with interest rates and inflation affecting those as well.
Yeah, I think as we go into earnings season and as we go into 2023, you're likely to see earnings growth slowing and continuing to slow. So that's pretty widely expected for the most part. When in the face of higher interest rates and also with higher prices out there, consumers are likely to start to slow spending somewhat. It's one of these waves that I was talking about. So we had the up wave coming out of the pandemic for goods, and then services. Things naturally have to slip back somewhat and can't continue at that pace for too long. So we're very likely to see that take place, and also to have inflation from the demand side settle back down. You need to reduce demand somewhat. So higher interest rates are intended to reduce that demand. So it's longer-winded way of saying we expect that earnings are likely to continue slowing and more pressure on profit margins going forward. The difficulty is knowing how much of that's already priced into stock markets. So, stock markets have declined significantly this year. Last quarter, we talked about the fact that there was a valuation correction that took place because of interest rates, probably starting to reflect some of the expectations for slower earnings growth as well. And it's tough to say where we're at in that period. So we could certainly see more softness or weakness in markets ahead as we start to get into weaker earnings. However, as we talked earlier about things not always being so obvious, it's also difficult to know whether that's going to cause the stock market to decline further. We've already had things come down somewhat. And the reason I say that is as we go into weaker economic growth and weaker earnings, expectations around interest rates are likely to change too. And what I didn't mention earlier is this is what really took place in July. So markets were looking through to the end of 2023 saying, well, economic growth is likely to soften. Central banks are going to have to pause their interest rate increases or perhaps even start cutting rates later next year. And this is that anticipatory piece of markets looking much further forward. And so we had equity markets in July and August move up based on expectations that the Fed was going to cut rates in late 2023. So already went through the entire increase in rates and already started to look at rates slipping. But my point is that there is some balance to that. So as we get into weaker economic growth going forward, if that does happen, then expectations around interest rates are also likely to change. We could see bond yields at least pause or perhaps start to soften somewhat, and that could provide enough offset for stock prices that, even if we have weaker earnings, we don't necessarily have to see stock markets suffer much further.
Yeah, a lot for the market to digest as all of this unfolds: interest rates, inflation, earnings. But let's try and end on a positive note here. What opportunities does that create? The sell off, the big swings, the indiscriminate sort of panic selling, if you like. We're a long-term investor. We're an active investor. We're not too focused in on day-to-day moves. We try and buy these companies for the long term. Does some of what's happening provide opportunities for an investor like us?
Yeah, that's an excellent point, David. So much of our talk has been relatively short term. When we're talking about a 12-month period or even anything plus or minus a little bit, that's relatively short term. And markets are a reflection of human behavior, and humans always take the most recent past and extrapolate that. And so you do have this pendulum swing with markets all the time. And we're kind of on the downswing at the moment. And so, you have very good companies that are not necessarily impacted so much by the short term, or at least their long-term story is definitely not impacted by what's taking place currently. And that as their stocks get punished for maybe no particular reason, it does provide opportunities for us to step in and to add to positions that we'd otherwise like to and perhaps have been too expensive for some time. So our research team always has an inventory list or just some of our current holdings that are perhaps affected. And they're on top of that all the time to either add new opportunities as they become cheap and more affordable, which we're starting to see more of, or adding to existing holdings that we really like. And the markets have brought them down for whatever reason, and it gives us a chance to chip away at those as well. So there are lots of opportunities that are uncovered. And every time you go through a period like this, it is a reset. So unfortunately, we don't get another up leg or longer cycle that's a more positive cycle until you go through a bit of a reset in the markets like we do right now. So as unpleasant as this is, it really sets up the next cycle.
Well, thanks very much, Greg. I appreciate that. I know there was a lot of talk about things everyone's heard before, interest rates and inflation, but it's really what's driving the market today. And appreciate you sharing your thoughts. And we'll see you again next quarter, I hope.
Yeah, thanks, David. And it is more of the same. Things don't change that quickly in 3 months. We could go back to our Q2 recording and pretty much just replay that because it's much of the same. So as you've pointed out, the topics don't change that quickly, but certainly lots of activity in the last few months.
Absolutely. Thanks very much.
All right. Thank you.